is the pattern of a wealthy person. This arrow simply flows from the asset box into the income box. The cash flow is not generated by a job or salary, but by assets. Remember, assets are things that put money in your pocket. Additionally, the rich have few expenses and liabilities, or if they do, those liabilities are more than covered by their assets. Examples such as these are oversimplified. Everyone has living expenses, the need for food, shelter, and clothing. The diagrams Rich Dad drew show the flow of cash through a poor, middle class, or wealthy person's life. It's the cash flow that tells the story. It's the story of how a person handles their money, what they do after they get the money in their hand. I cringe whenever I hear people ask me how to get rich quicker. Or how do they start? I often hear, I'm in debt, so I need to make more money. But more money will often not solve the problem. In fact, it may actually accelerate the problem. Money often makes obvious our tragic human flaws. Money often puts a spotlight on what we do not know. That's why, all too often, a person who comes into a sudden windfall of cash, let's say an inheritance, a pay raise, or lottery winnings, soon returns to the same financial mess, if not worse than the mess they were in before they received the money. Money only accentuates the cash flow pattern running in your head. If your pattern is to spend everything you get, most likely an increase in cash will just result in an increase in spending. Thus the saying, a fool and his money is one big party. Because students leave school without financial skills, millions of educated people pursue their profession successfully, but later find themselves struggling financially. They work harder but don't get ahead. What's missing from their education is not how to make money, but how to spend money. What to do after you make it. It's called financial aptitude. What to do with the money once you make it, how to keep people from taking it from you, how long you keep it, and how hard that money works for you. Most people cannot tell why they struggle financially because they don't understand cash flow. A person can be highly educated, professionally successful, and financially illiterate. These people often work harder than they need to because they learned how to work hard, but not how to have their money work for them. The moving picture show of hard-working people has a set pattern. Recently married, the happy, highly educated young couple move in together in one of their cramped rented apartments. Immediately they realize that they're saving money, because two can live as cheaply as one. The problem is, the apartment is cramped. They decide to save money to buy their dream home so they can have kids. They now have two incomes, and they begin to focus on their careers. Their incomes begin to increase. As their incomes go up, their expenses go up as well, so there is little or no money to flow into the asset box. This means the only income they get comes from their jobs. The number one expense for most people is taxes. Many people think it's income tax, but for most Americans, their highest tax is Social Security. As an employee, it appears as if the Social Security tax, combined with the Medicare tax rate, is roughly 7.5%. But it's really 15%, since the employer must match the Social Security amount. In essence, it is money the employer cannot pay you. On top of that, you still have to pay income tax on the amount deducted from your wages for Social Security tax. Income you never receive because it went directly to Social Security through withholding. Then their liabilities go up. This is best demonstrated by going back to the young couple. As a result of their incomes going up, they decide to go out and buy the house of their dreams. Once in their house, they have a new tax, called property tax. Then they buy a new car, new furniture, and new appliances to match their new house. All of a sudden, they wake up, and their liabilities column is full of mortgage debt and credit card debt. They're now trapped in the rat race. A child comes along. They work harder. The process repeats itself. More money and higher taxes, also called bracket creep. A credit card comes in the mail. They use it. It maxes out. A loan company calls and says their greatest asset, their home, has appreciated in value. The company offers a bill consolidation loan because their credit is so good and tells them the intelligent thing to do is clear off the high-interest consumer debt by paying off their credit card. And besides, interest on their home is a tax deduction. They go for it and pay off those high-interest credit cards. They breathe a sigh of relief. Their credit cards are paid off. They've now folded their consumer debt into their home mortgage. Their payments go down because they extend their debt over 30 years. It is the smart thing to do. Their neighbor calls to invite them to go shopping. The Memorial Day sale is on. A chance to save some money. They say to themselves, "I won't buy anything, I'll just go look." But just in case they find something, they tuck that clean credit card inside their wallet. I run into this young couple all the time. Their names change, but their financial dilemma is the same. They come to one of my talks to hear what I have to say. They ask me, "Can you tell us how to make more money?" Their spending habits have caused them to seek more income. They don't even know that the trouble is really how they choose to spend the money they do have. And that is the real cause of their financial struggle. It's caused by financial illiteracy and not understanding the difference between an asset and a liability. More money seldom solves someone's money problems. Intelligence solves problems. There's a saying a friend of mine says over and over to people in debt: if you find yourself in a hole, stop digging. The poor and middle class all too often allow the power of money to control them. By simply getting up and working harder, failing to ask themselves if what they do makes sense, they shoot themselves in the foot as they leave for work every morning. By not fully understanding money, the vast majority of people allow the awesome power of money to control them. The power of money is used against them. By the time Mike and I were 16 years old, we began to have problems in school. We were not bad kids. We just began to separate from the crowd. We worked for Mike's dad after school and on the weekends. Mike and I often spent hours after work just sitting at a table with his dad while he held meetings with his bankers, attorneys, accountants, brokers, investors, managers, and employees. We learned more sitting at his meetings than we did in all our years of school, college included. Mike's dad was not school-educated, but he was financially educated and successful as a result. He used to tell us over and over again, an intelligent person hires people who are more intelligent than they are. So Mike and I had the benefit of spending hours listening to, and in the process learning from, intelligent people. But because of this, both Mike and I just could not go along with the standard dogma that our teachers preached. Occasionally, Mike or I would ask our teachers how what we studied was applicable, or we asked why we never studied money and how it worked. To the latter question, we often got the answer that money was not important, that if we excelled in our education, the money would follow. The more we knew about the power of money, the more distant we grew from the teachers and our classmates. My highly educated dad never pressured me about my grades. I often wondered why, but we did begin to argue about money. By the time I was 16, I probably had a far better foundation with money than both my mom and dad. I could keep books. I listened to tax accountants, corporate attorneys, bankers, real estate brokers, investors, and so forth. My dad talked to teachers. One day, my dad was telling me why our home was his greatest investment. A not too pleasant argument took place when I showed him why I thought a house was not a good investment. The argument illustrated the difference in perception between my rich dad and my poor dad when it came to their homes. Poor dad thought his house was an asset and listed it in the asset box, and the rich dad thought it was a liability and put his home in the liability box. I remember when I drew a diagram for my dad showing him the direction of cash flow. I also showed him the ancillary